Since the early April tariff-induced sell-off, investors are piling back into risk-on trades with both Invesco's Nasdaq 100 pegged ETF and iShares small caps ETF both back in positive territory. But there are still concerns ahead, especially when it comes to the dollar still being under pressure. For this, I want to bring in Aniket Ullal, CFRA Research's head of ETF research, for this week's ETF report brought to you by Invesco QQQ. Aniket, great to have you here. Talk to me about what you're seeing in the flows. It seems like investors are buying a little bit of risk in everything.
Well, we try to look at both performance and flows in tandem because sometimes flows can lag performance. From a performance perspective, what you said earlier is absolutely right. We saw a bottom on April 8th, which was, of course, the date when President Trump paused reciprocal tariffs. Since before that date in the year, SPY was down 18%. IBIT, the Bitcoin ETF, was down significantly, as was QQQ, which is really the best proxy from an ETF perspective for the AI trade. All of those ETFs have bounced back significantly since then, most of them 20+%. In the case of IBIT, more than 30%. So from a performance perspective, we have seen investors really go back and kind of take on more risk. To your point about the flows, there are certain categories where we've seen significant inflows. Defense ETFs is one of them, crypto is another. So, both from a flows and performance perspective, it's a much healthier environment now for ETF investors than, of course, early April.
Yeah, and talk to me about those flows into defense ETFs. What is that signaling to you about sentiment?
That, I think, is really driven by what's happening in the budget reconciliation process. If you look at the budget, there's another $150 billion allocated to defense. This is on top of the $850 billion, of course, in annual spending that's funded through a continuing resolution. So, this includes $27 billion for the Golden Dome project, which President Trump has kind of talked about quite a bit. So this really benefits, of course, the large defense contractors. You've got ETFs like ITA, which provide exposure to the big defense contractors. But there's also another huge component here, which is software automation, process automation, benefits firms like Palantir, C3.ai, and ETFs like PPA, which are kind of broader in terms of their defense exposure and hold some of the software and kind of process automation companies, actually benefit a lot from the defense trade. So we actually think PPA is a good proxy, which is an Invesco defense ETF, for the kind of broader defense play when it comes to benefiting from the budget reconciliation process.
That's a really great overview. I want to have you do the exact same thing, but for international ETF flows. What are you seeing there, and what is it indicating to you about where, or I guess how convicted investors are in the narrative that international is going to continue to outperform U.S.?
It's going to be interesting to see how patient investors are with international. In the past, we have seen investors sometimes go to international when we've seen some weakness in the US and then pull back. So far this year, flows have been very strong, particularly within Europe. And we're starting to see in emerging markets ex-China be kind of an interesting trade. Within Europe, of course, Germany is one of the engines of Europe. We've seen stimulus in Germany in terms of 500 billion euro infrastructure bill, spending allocation. We've seen defense stocks really lead that. And the way we think about European allocation is it's really a complement to US allocation because US ETFs are very, very tech dominated, very dominated by the AI trade. If you look at European ETFs, in general, they tend to have less than 5 to 10% of their exposure to IT. It's a lot more financials, it's a lot more industrials. And industrials really benefit from some of the stimulus we talked about. So we think European trading is here to stay, but it's really non-tech driven. It's much more in industrials and financials play.
Yeah, so given that, because the US continues to win when it comes to large cap tech, how much is the US equity market sort of relying on a dollar snapback in order to have some sort of catalyst to newer all-time highs?
I think your intro, you said it well, which is that, is this 2024? Probably not, because, there are factors that are different now than we saw last year, right? Which was a very AI-driven trade. Now we've got dollar weakness. We've got much more, of course, driven by tariff uncertainty. So this year, we've seen the dollar, if you look at a trade-weighted basket index of the dollar against trade-weighted basket of currencies, it's down about 5 to 6% this year. That's actually an improvement from a couple of weeks ago. And because of that, we've seen money go into currency ETFs. You look at ETFs like FXY, which is kind of a yen USD trade. That's taken in over 400 billion. FXC, which is the Euro USD pair, is taken in 300 million. So we have seen investors kind of go into currency ETFs as a way to capture some of this dollar depreciation. We have seen dollar depreciation moderate a little bit, but I think there's a lot we need to watch in the next couple of weeks, particularly with what happens with the pause on tariffs on July 9th and how that plays out.
Aniket, really appreciate you joining us. Thank you so much.
Thank you.